The stock market has been on a wild ride lately. One moment it's pushing higher and the next it's pulling back, leaving investors wondering what's coming next. But here's something interesting. While VU, which tracks the S&P 500, has dipped nearly 1% this past month, SCHD has actually gone up. Now I know a single month doesn't tell the full story, but this is a perfect reminder of why SCHD is such an important piece of a well-diversified portfolio. Markets go through ups and downs, it's inevitable, but when things get uncertain, you want investments that provide stability, cash flow, and long-term resilience. And that's exactly why I've been investing into SCHD every single day. In this video, I'm going to break down why SCHD is one of the best ETFs to own as part of a diversified portfolio. But before we dive deep into the reasons, let me tell you what made me start building my position in SCHD. Like many investors, I went through some painful lessons in the market, especially in 2022 when tech stocks collapsed and portfolios that were heavily concentrated in growth stocks saw massive drawdowns. That's when I realized that to build real long-term wealth, I needed a balance of growth and stability. That's what led me to SCHD. Since January 1st, 2024, I've been investing $5 a day into SCHD, no matter what the market is doing. And as of now, I have over 80 shares worth more than $2,250. And this is just the beginning. I plan to build SCHD into a substantial position in my portfolio. And after hearing these reasons, you might want to do the same. Reason number one, SCHD's dividend growth. Over the past 5 years, SCHD's dividend has grown at an average annual rate of 11.59%. That means the dividends you earn don't just stay the same, they increase every year, compounding into even greater returns over time. To show you just how powerful this is, let's break it down. If you buy one share of SCHD today at $28.54 based on today's 3.57% yield, that share will pay you approximately $1.02 in dividends over the next year. But here's where the real magic happens. SCHD's dividends don't stay flat. They grow each year, assuming dividends increase by 11.59%. Here's what happens to that single share's annual dividend payments over time. In year one, we're earning that $1.02 based on that 3.57% yield on cost. By year 5, we earn $1.58 with a 5.54% yield on cost. And at year 10, we're being paid $2.73 per share at a 9.57% yield on cost. So in 10 years, even if SCHD's stock price doesn't appreciate, which is unlikely, the dividends you receive will have nearly tripled, meaning your yield on cost jumps from 3.57% to 9.57%. But let's keep going. Reason number 2, capital appreciation, growing your investment over time. Beyond its impressive dividends, the Schwab U.S. Dividend Equity ETF also has delivered strong capital appreciation, making it a powerful investment for both income and long-term growth. If we look back 10 years to March 2015, SCHD was trading around $13 per share. Fast forward to today, and SCHD is priced at $28.50, meaning its share price alone has more than doubled in the past decade. This shows that while SCHD is a dividend-focused ETF, it also delivers steady price appreciation over time, adding another layer of growth to your portfolio. Reason number 3, stability in volatile markets. SCHD isn't just about dividends and growth, it's also about stability when the market gets rough. This ETF is built around high-quality, financially strong companies that generate consistent earnings and cash flow, businesses that can withstand economic downturns and continue paying dividends even when times get tough. One key reason SCHD tends to be less volatile than the broader market is its sector composition. Unlike the S&P 500, which is heavily weighted toward high-growth tech stocks, SCHD limits its tech exposure to around 10%. This is a key distinction because tech stocks perform well in bull markets, but tend to be highly volatile during downturns. SCHD focuses more on dividend-paying sectors like consumer staples, healthcare, and industrials, which historically hold up better in bear markets. It still includes some tech stocks, but in a way that balances exposure while reducing risk. This sector balance makes SCHD a great choice for investors who want stability without sacrificing long-term returns. Now let's take a look at this chart comparing SCHD and VU over the last 10 years. For most of the time, SCHD and VU have tracked fairly close together, showing that both are strong long-term investments. But look at what happens in 2022, the year when markets faced a sharp decline. SCHD actually outperformed VU. This highlight is a key advantage of SCHD. When the market struggles, dividend-focused funds like SCHD tend to hold up better. Investors rotate into high-quality, cash flow positive companies for safety, which benefits SCHD's holdings. Now fast forward to 2023 and 2024, and we can see that VU is pulling ahead. That's because growth stocks, especially in tech, thrive in bull markets, while SCHD remains more steady. This is exactly why I hold both SCHD and VU. When markets are strong, VU captures that high growth upside. When markets get rough, SCHD provides stability and dividends. Reason number 4, how SCHD selects and rebalances its stocks for maximum quality. Not all dividend ETFs are created equal. One of the biggest advantages SCHD has over other funds is its strict stock selection and annual rebalancing process, ensuring it always holds only the highest quality companies. SCHD follows a rules-based methodology that screens stocks for quality and sustainability. Here's what it looks for. Strong profitability. Companies must have at least 10 consecutive years of dividend payments and solid financials to qualify. A return on equity, prioritizing companies that are efficient with capital, meaning they generate strong returns for shareholders. High free cash flow to debt ratio, ensuring companies aren't overloaded with debt, which makes dividends more sustainable and less likely to be cut. These strict criteria prevent SCHD from holding companies that pay dividends just for the sake of it. It focuses on businesses that have a track record of financial strength and shareholder returns. Let's take a look at SCHD's annual rebalancing or reconstitution, which is coming up later this month. Unlike some dividend ETFs that hold on to the same companies indefinitely, SCHD rebalances once a year, ensuring its holdings remain high quality and financially strong. SCHD isn't just a dividend ETF, it's a carefully managed fund that continuously adapts to hold the strongest dividend payers. Reason number 5, low expense ratio. Keep more of your money. One of the biggest hidden costs of investing are expense ratios, the fees that funds charge to manage your money. And this is where SCHD has a huge advantage. SCHD's expense ratio is just 0.06%, which is one of the lowest in the entire ETF industry, especially impressive given how carefully the fund is structured and rebalanced each year. Low fees really do matter because you pay less in fees with SCHD, more of your money stays invested and compounds over time. I want to take just a second to discuss SCHD's limitations. SCHD is one of the best dividend ETFs, but no fund is perfect. It's important for investors to understand where SCHD has trade-offs so you can make the best decision for your portfolio. Number 1 is sector concentration is not as diverse as broad market funds. SCHD leans heavily toward financials, industrials, and healthcare while having less exposure to technology. This means if financials or industrials struggle, SCHD could underperform relative to broader market funds. Unlike the S&P 500, SCHD limits tech exposure to around 10%. This reduces volatility in downturns, but can also lead to underperformance in tech-driven bull runs like we saw in 2023 and 2024. And rebalancing can be a double-edged sword. SCHD's annual reconstitution removes weaker companies before they decline further. However, it's possible that some removed companies rebound later, meaning SCHD could miss out on certain recovery plays, which has happened in the past. None of these are deal breakers, but they highlight why SCHD works best as part of a balanced portfolio rather than your only investment. Reason number 6, combining SCHD and VU makes the ultimate ETF. Earlier, we talked about how SCHD and VU work incredibly well together. One provides broad market growth and the other delivers dividend income and stability. But let's take a moment to break down why these two ETFs make such a powerful combination. VU gives you exposure to the entire S&P 500, including high-growth tech stocks that can drive big returns in bull markets. SCHD, on the other hand, focuses on high-quality dividend players, providing strong income stability and lower volatility during downturns. If you're an investor looking for a simple but highly effective portfolio, pairing SCHD with VU is one of the smartest strategies out there. Now let's take a second to compare SCHD versus other dividend ETFs you might consider. SCHD is one of the best dividend-focused ETFs, but it's not the only one. If you're looking for a different style of dividend ETF, here are a few to consider. VYM, the Vanguard High Dividend Yield ETF. This fund focuses on high-yield stocks, but doesn't screen as heavily for quality as SCHD. It typically has more holdings and a slightly higher financial sector weight. Then we have Noble, the ProShares S&P 500 Dividend Aristocrats ETF. This fund holds only companies that have increased dividends for 25 plus years. It's a more conservative option with strong dividend growers, but has a slightly lower yield than SCHD. We have DVY, the iShares Select Dividend ETF. It has a higher dividend yield than SCHD, but less focus on growth. This fund tends to hold more utilities and energy stocks, making it more defensive, but with less price appreciation potential. For me, SCHD strikes a great balance between yield, dividend growth, and capital appreciation. Unlike some high-yield ETFs that sacrifice quality, SCHD's strict stock selection ensures sustainability. SCHD is an incredible fund. It delivers strong dividend income, consistent capital appreciation, and lower volatility. It's not perfect, but when combined with a broad market ETF like VU, you get a powerful investing strategy that balances growth and income. I personally invest in SCHD every single day, and I plan to keep building this position for years to come. What do you think? Do you own SCHD? Are you planning to add it to your portfolio? Please let me know in the comments. If you found this video helpful, don't forget to like and subscribe. And if you're not sure what to watch next, check out another one of my videos right here. I think you'll really enjoy. Take care, and I'll see you next time.